Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending January 13, 2023. So Friday the 13th, but when we look at the markets, it's there's not much red there, pretty positive year to date and also on the week for bonds and equities. So year to date, we're at almost 6% return for the long bond index. So that's good. We are expecting some volatility in interest rates through the year. So doesn't mean that even if we have a strong start that will make up for all of the losses of 2022, but we are expecting good things from fixed income during the year. For equities, an outperformance in local currency for the TSX this week, but pretty much positive everywhere. S&P 500, NASDAQ, EFI, emerging markets. NASDAQ reacting a bit stronger this week because lower rates is good for technology stocks, so that's helping there. But year to date, pretty much green everywhere, or black here, except for oil, which is quite volatile, 6% return this week alone. But other than that, Canadian dollar up, euro up, and the price of gold having a strong start. So we are looking at adding some gold into the portfolios. We waited to make sure that our analysis structure was up to par. I wanted to make sure that the fundamentals were sound, and we are getting convinced that maybe it's time to put some gold in the portfolios. We're also looking at maybe upgrading Canadian equities, European equities, emerging market equities for 2023 because they're really cheap, but we're not yet warmed up to the idea of adding on the S&P 500. So regional bets are just about to re-enter the fray here in our framework after second half of 2022, when correlations meant that we were more careful about playing on the geographical aspect. Within equities, we thought it was a good idea to just underweight every region the same, and that was the strategy in 2022. We're looking at changing that. So when we're done with the trades and when the positioning is made, we'll communicate that to you. Inflation, again, the topic of the week, especially in the US this time. Next week, I'll be talking about Canadian inflation again. We need to continue to talk about inflation in early 2023. That's still the topic of importance because the markets are focusing on that very importantly. Now in the US, slowing down, as you can see here, mostly from gasoline and car prices, because as you can see, the light shade of blue component here, which is transportation. So gasoline prices were lower on the month in December, and year over year, the base of comparison for the previous year is getting higher and higher, so that helps. That's a headwind for inflation in gasoline. Also, used car prices are falling year over year. New car prices, inflation is moderating there. But outside of transport, we're not really seeing any moves here. So if we go on a month over month basis in 4 categories, as you can see on the next slide here, well, you have core goods on the left and core services on the right. So core, that means that you remove the most volatile components like food and energy. Goods inflation has been slowing down and even now contracting for a while, so this is a known story. But on the right, the focus from the Fed and central banks are on the services component, because services inflation is tightly linked to wage inflation, and wage inflation, that's the crux. That's where they're working at, because if there's an inflation spiral that's hard to control, it will come from higher inflation leading to higher wage demands, and higher wage demands leading to more inflation, and then it's hard to unwind all of that. So services inflation is in focus, and month over month, we're still seeing some strong inflation there. But still, inflation is slowing down. We're expecting it to slow down through the year. At some point, the story will be fading. Markets won't be as nervous from inflation, but now we're getting into the other phase of just trying to guess when the Fed will stop raising rates. How high will the rates be then? And after that, well, when they start cutting. And right now the markets are starting to be pretty optimistic about that. More on that in a few minutes. But the Federal Reserve speakers are pretty adamant that they'll be raising rates above 5% and keeping them there for a while. So that's going to be the next part, or we're already in there, but that's going to be what's going to be driving markets over the next few weeks, maybe months. But then after that, even when all of that is done, we'll still have to deal with an economy that is, under the weight of all of these rate hikes that have been accumulated over the last year or so around the world. So, there's still ample room for volatility here. That's the message. So if you look at the real economy, well, here on this slide, you see the small business optimism index from the NFIB is pointing towards, lower levels still. So business owners are not optimistic. They are looking at the weight of all of these rate hikes and a slowing demand for their products, dimmer prospects for investment. So this is what they're seeing. But when we look at the next slide here, the markets are quite optimistic to start the year. On the left, you have the views from the markets, what's actually priced into the markets for rates from the Fed in 2023, the second half of the year. What you see here is the market pricing, the change in H2. That means markets are thinking that the Fed will be cutting twice, 50 basis points in the second half of 2023, which flies into the face of the message that what the central bankers are saying. So there's always a risk that central bankers bend to the pressure of the markets, bend maybe to some political pressure, and that they do start to unwind early in 2023. But our base case is that they do what they're saying, and they will keep rates high until all the way through 2024, and that means that we will need some market adjustments at some point or some volatility. And on the right, you see the trend. So the S&P 500, the resistance that we've seen since early 2022 has been pretty strong. So the market keeps hitting its head on this resistance. We're just about to hit it here. So until we see a breakthrough through this resistance with some conviction, we'll continue to think that we're in a downtrend here in the US. So we see opportunities to add value outside of the US. Canada, Europe, China, for example, seem to be good places to start being active in, but for the S&P 500, we're still thinking it's not yet. So what to watch next week in Canada? I don't have consensus expectations here, but Bank of Canada Business Outlook Survey, CPI inflation, so I'll be talking about inflation again next week, retail sales, and Teranet National Bank Home Price Index. We're getting close to minus 10% for the housing prices in Canada from the peak. Likely we're going to go to minus 15 to minus 30%. This is the scenario that we're expecting. That still doesn't mean there was a bubble or there is a bubble, just that there was some froth, and we're seeing a market that is readjusting here, but we'll follow that for sure. And in the US, retail sales and industrial production should both be lower. So that wraps it up for the week. ia.ca/economy. You can subscribe to the newsletter if you haven't done so already. In Your Interest podcast, there's always some new episodes. We just came out of the studio to record 3 new episodes, so stay tuned and keep following it. Economy Finance 101, so new material is coming. And social media, Twitter and LinkedIn. As always, you can follow me there. So that wraps it up for the week. Thanks for following us, and I'll be back again next week.